Hello, everybody. Anu, Ethan, thank you very much for joining me. I think I've done 4 or 5 of these kind of panels over the years at Bloomberg, and this is the first one where I can get up here and honestly say it's not a good M&A market. It's a tough time. It's a tough time to feel optimistic about it, but I think we're going to try and get to some of that in this discussion. But look, lots of things holding back M&A at the moment, lots of things that have proved to be quite significant headwinds for the last sort of 9 months to a year. Regulation is, for me, the most interesting piece of that. So, Anu, I'll start with you. We're in this environment now where you have a ton of regulation, a ton of fairly novel regulation that companies are grappling with as it relates to M&A. Are you seeing anything to make you feel that clients are getting better at navigating that or getting more comfortable with the environment as it stands?
Yeah, you're right. This is a tough market, so you need people with courage, and you need people with experience through cycles, because that is what most clients are looking for, to say, this is a new environment, whether that is regulation or any aspect of it. And how is it that we deal with something that we don't know? How do we deal with the unknown? And that's a little bit of what the regulatory environment is dealing with the unknown. So it used to be that you would ask a law firm and they would come into the boardroom and you'd say, well, what are the chances of this deal getting approved? And now the approach is no longer that. It's a bit more saying, what makes strategic sense for us? We know that whatever is the path that you pursue will have regulatory hurdles. And so how is it that we prepare for that? So that itself is a shift in approach. And so how do you prepare? You got to think about, one, when you go knocking on the door of the counterparty, one of the questions they're going to ask is, how much work have you done? Why should I believe that you can get this deal to the finish line? And so if you're the one who's doing the knocking, then prepare. If you're one on the receiving end, know how to ask the right questions. And the next part of it is, how do you actually negotiate a contract with enough flexibility for you to run the company for the very long, unpredictable time period between signing and closing? How do you protect your franchise such that if the deal does not close, you don't have the empty shell of a company? And if you are a buyer, how much are you willing to litigate? Because the level of litigation, I'm sure Ethan will talk about it, has increased about 4 times. And so it's some of the traditional things we talked about, hell or high water, or there's a high enough break fee so that you feel good about that. Some of those are no longer enough.
Right.
And instead, what you need is real commitment from both parties to say, we're going to fight it, and we're going to play to win.
Ethan, from where you stand, is that the case, that companies are basically, as they go into transactions, assuming we are going to have to fight the FTC or we are going to have to fight the DOJ? And that being the case, what does it mean for the way they think about the deal? Does it change the price? Does it change the way they assume they're going to be able to absorb the asset?
You know, a couple of years ago, boards would have been quite freaked out by the idea that all of a sudden you're telling you have to litigate against maybe multiple governments. Right. In order to get the deal through. At this point, as Anu says, that's part of the game. If you're going to be in the M&A game and that's the way you're going to improve your company in a non-organic way, that's part of the playbook. And so I spend just as much time as an M&A lawyer with my antitrust litigators as I do with my merger clearance guys, who are the guys who file the documents. And often, I'm sending the antitrust litigators to the meetings with the regulators as opposed to sending just the merger clearance folks. So, yeah, that's a big part of the strategy now.
It's a brave new world where you have to show up to a pitch meeting with your antitrust litigators to convince companies that it's time to dance. But look, a big sort of part of the regulator's ambition here, at least when I think about the FTC and the CMA, similarly in the UK, is they want to stop people thinking about deals by actually having this chilling effect. And right. It seems to be working. I mean, isn't this exactly what they were supposed to do? They slow down M&A because they make people think, actually, we just can't be bothered with the fight.
Well, on the one hand, I think there's been the game has been upped on the side of the merging parties. It is true there's a number of deals that no one knows about because they're not happening. But when companies see a deal that really is going to be critical to their strategic rationale going forward, the game has been upped. And the idea, there's been a whole wave of deals I've worked on where we've done what we call fix it first. So we don't even wait for the suggestion. We just go in, sometimes even before we make a filing, and divest problematic assets. There's been a wave of situations where we coordinate with the way we're handling it with CMA, where we don't give timing agreements as much anymore. Because there used to be this thing where, oh, you're talking to the agency, and they say, well, just give us a timing agreement and extend the process out more, and maybe we'll reach an understanding on how to get this done. They've advertised. The heads of the antitrust heads at the U.S. agencies have said, we're not interested in...
You don't want to understand.
We don't want a settlement. They don't want settlements. They think that they don't work. So why should we give timing agreements? So that, if you can do that, that goes to Anu's point. Once you get rid of timing agreements, you accelerate the time between signing and closing. Yep. And you can get right to the heart of it and get to an Article 3 judge, many of whom don't view antitrust laws the same ways as the current occupants of the U.S. agencies. And then there's also, you have to play in Europe as well. And you have to play this whole triangulation of the Commission, CMA, and the U.S. agencies off each other.
So when I think about regulation and indeed the other things that are sort of addling the M&A market generally, I think it's a perfect time for private equity. They have vast amounts of unspent capital. You have lower valuations, which obviously they talked about for years as being the thing they wanted to see before they came into the market. Yet we haven't seen the wave of LBOs I think a lot of us expected. And Anu, I'll ask you about it first. Like, why is that? What are you hearing from private equity clients in terms of what's going to tip them over and get them into the market in a meaningful way?
Yeah. So the private equity, the dry powder available is more than $2 trillion. That's the amount of money available to deploy in buying assets. But what is it that you need? You need the availability of assets. You need the seller to have the right view on value. You need financing. You need to have a path to exit. And you need to have courage of conviction. And these 5 things are all shaky. So one, the assets that are proactively coming to market, not very high. I was talking to a bunch of private equity people at a roundtable, and each one was giving statistics of the number of deals that they have seen quarter by quarter. And this past 3 months is probably one of the lowest pipeline of deals proactively coming to them. So firstly, availability is not there. Second, value expectations, there continues to be a mismatch. You're talking about the public equity market valuations but give me a company who's happy with their stock price.
Right.
So you have to have a seller who is willing to sell at a price so that it continues to be a meaningful valuation mismatch, which sometimes can be bridged with creative structuring, but not always. Debt financing is more expensive, available for the deals that are happening, but yes, more expensive. That affects the calculus on valuation. When you think about exit, you have 2 challenges. How do you know what is the equity market valuation that you're going to exit at? And second, if you're thinking about a strategic deal, the regulatory environment, right, which we just talked about, the bar's gotten higher, right? So I can't bet on either option, or I'm putting a whole bunch of risk adjustment. And I'd say the biggest thing is courage of conviction. And there's just, we often say M&A is a confidence game as much as anything else. And so when people don't feel confident, they just do less M&A. That goes for public company boards as well as investment committees. So what needs to change for that to happen? I think the better assets coming to market, which we are beginning to see. Mm-hmm. Equity markets showing some robustness, and generally having a bit more certainty and confidence. So psychologically, I think the debt ceiling, getting through it helps. Having some clarity on interest rates, I think helps. So more number of uncertainty that you take out, you have more courage.
But Ethan, doesn't that drive it away from the private equity buyers? Because as those things start to line up again, we're going to see valuations go back up, which means it's going to be harder for the sponsors to play in certainly in the public markets. I mean, private market valuations are more sticky and so have come down less anyway. But yeah, it just seems interesting. Like, why wait? Why you have all this money to spend? You do have the availability of financing. I mean, the direct lenders are constantly telling me they're there and they have money and they want to do stuff. So it's
you have about a dozen guys or so who are contrarian and who are actually investing a lot. And I think these will be some of the best deals because this is a buyer's market. And I think if you're a strategic who has money or a sponsor who has money,
and conviction.
And if you don't do a deal in 23, I think you're going to kick yourself.
Yeah.
It is. I think one of the key ingredients where we're having trouble, though, is on the debt financing side, because that really is the special sauce of private equity, and that is expensive. If you're using the direct lenders, it's frankly exhausting. When we represented Coupa in the sale there, I mean, we had 23 direct lenders come together. They don't step up the way you do with 2 or 3 commercial banks. And it's hard, it's uncertain, you don't know that they're there till the end. And then you have things where there are a number of deals where we're having extraordinary equity checks being written. Like in the Qualtrics deal, $12.5 billion for all equity. So I think on the equity side, it's a little bit commoditized, but building out that rest of the capital structure, I think still has a lot of challenges, and it's expensive. If it becomes a little more certain, there's more banks involved, and the bond market can be available, the high-yield bond market, then the banks will become more involved, and everything will start to flow a lot better, I believe. There's still a lot of companies that have had tremendous stock shifts in the last several months, and those guys are, as far as we know, the gap on valuation, I think time is not on their side. Right. And time is on the side of private equity, right? So those companies are ripe for sales. And a lot of them, the reason their stock price has gone down is simply they're spending a lot of money on R&D, a lot of money on marketing, and they're going to have to for the next 4 or 5 years. And then they'll get to a point where I think their margins will be able to expand. So that could be works very nicely for the private equity formula. I think we're going to see a lot more private equity take privates in the next 6 months based on those kind of companies that have nice cash flow, a lot of them software type companies that have nice cash flow and just need to get through a period before their margins are going to expand.
And a period that's probably better out of the glare of...
Yeah, better out of the glare.
Away from the activists. Yeah. The IPO market has obviously also been fairly challenged through this period. I wonder if there are sort of decent targets that companies can look at that are pre-IPO, maybe like to be out there in the public market, need some kind of financing, but just can't get there because there's just not the appetite.
I think those are all good hunting grounds for deals, right? So like I said, if you're a buyer, you should be looking at every place and trying to find negotiated deals. The company is about 400 plus companies went public in 2021, but are not fully exited, right? So you still have a controlling shareholder and the stock price is meaningfully. There's 300 plus de-SPAC transactions. Some of them are really good companies and are trading at a deep discount.
Some of them are bankrupt.
Yeah, some of them are.
A lot of them are not really good companies.
Yeah, companies which are waiting to IPO. And now you see, again, beginning of conversations in all these pockets. But still, I'd say largely domestic.
Right.
Cross-border is still very muted.
So one kind of transaction that was rife really through the last few years and does seem to still be happening is the corporate clarity deals where you're seeing companies, instead of doing whole company transactions, spinning off a division, breaking themselves up into multiple divisions and being standalone in the public markets. Shareholders don't seem to like it. They didn't love it before. They still don't seem to love it now. I wonder why clients still see this as a sort of a useful thing to be doing with the business.
I think I'm not sure shareholders don't like it. I think the stock price of the company that announced the corporate clarity transaction has not re-rated up the same way it has in the past. So usually there is on average a 5% or so a share price increase. Sometimes it's a lot more than that. In the more recent time, you haven't seen that. But it's a hard thing to figure out because the entire market is down.
Right.
So if you had not done that, I mean, you can do a lot of corporate finance brain damage to try to figure out what the right answer is. But the driver of why a company thinks about it, because focus, having the right shareholder base for each part of your business, being able to use your currency for transaction, having the right equity research for that company, and separating higher growth businesses from lower growth businesses. Those theses still seem to hold. And another big driver of it is, frankly, I feel like we keep going back to your first question, regulation, is because you could take one of these pieces and maybe in 2021 or whatever, we'd have sold them.
Yep.
But now you're like, I'm going to spin it because I don't know whether, I don't know how long it's going to.
You don't want to spend 2 years fighting regulators just to sell it.
Instead, at least I'll spend 2 years doing something where I control my own destiny.
Yep.
I mean, part of the problem is we're separating low growth from growth. A lot of the growth companies just aren't getting much bang for their buck. And so it's not necessarily that there's not still logic in doing the separation. It's just it's not hyper logical
Right.
the way it used to be because the difference in multiples is not as great. I think there's more excitement, and I think for the next half of the year, we're going to see more, I think, mergers of equals, where we have stock combinations, including cross-border, I think, because it's just, there's a logic to those deals where you have synergies. I think, you have to be thoughtful about regulatory.
I was going to say, synergies is a word regulators hate right now because they say, well, then there must be a reason you're getting together because it's going to squeeze other competitors.
Yeah, but you can find some complementary ones. And also, as I said, you got to be ready to go to war from the get-go. And so those are deals, especially when you don't feel like there's a great runway over the next 7, 8, 10 months. Like, why don't we do something for the shareholders? So half the board may have to step down, and we don't know what's going to happen to management, but they're great ways to deliver value to shareholders. And I think there's been enough stagnation that there's going to be a push to do those kind of deals.
Because the big driver is still the need for scale.
Right.
Yeah.
Right? Because with that money, because, I don't know why synergies has become a bad word, because you do actually have to invest a ton in a company to address your supply chain concerns. Yeah. You have to invest to digitize at a pace that you never thought you would have to. Where is that going to come from? Right? It's not like cash flows and growth are gangbusters. And so the benefits of scale are there. So I completely agree with Ethan that I think the combination of equity markets where both the stock valuations are challenged, where debt is more expensive. I mean, this is a case study for why you should do MOEs.
Yes.
Right. Maybe we'll get some big ones in the second half of the year. So just before we end, I want to turn to activism, which, from where I sit, and maybe this is unfair, but it seems like it's gotten a little less interesting the last few months. Or activists look a little less smart when the market isn't going up and up and up. And I wonder, we're seeing some campaigns, not particularly novel ideas, but with some success nonetheless. And what are activists doing when they're getting on the boards of companies? What are they able to do that is in any way different from what the existing boards are doing as it relates to M&A, breakups, anything that, is, as we've just been talking about, is challenging in this market?
I mean, when you're not at the mega caps, their home run is to put the company in play, right? So they try and do that. Nobody wants to buy a company brokered by some activist hedge fund, but they're trying to put the company in play. Sometimes they have operational ideas. Almost always sometimes they're decent ideas, but the guys on the inside have such an informational advantage that they usually have already thought that through, and sometimes they're rowing in the same direction. A lot of times I have to get clients over the hump of saying, let's give the guy some credit. Who cares? It's the good idea that we were thinking about doing anyway. And then at the large caps, as we've seen, there's been this big push for cost cutting. Okay, brilliant idea, but that's really where the game is. So it's cost cutting, some operational ideas, which are usually not super well informed, and then I see trying to put companies in play who could be candidates for sales, especially a private equity. I don't think they're really. I think there's mostly my clients are thinking like activists anyway for the last 5 years, and they're not waiting for the activists to get on the board to think this stuff through, and they're mostly there's been a whole sea change really on this, and so the 12 celebrity activists are not the only ones who have ideas about how to move these valuations up.
Yeah, I think they have twin things. Activism has become an asset class like many other asset managers with more than 100 billion plus AUM. So that has totally changed the dynamics of that. That whole asset class doesn't think similarly, doesn't act similarly, doesn't have the same motivations.
Right.
On the other side, the bigger change, I think, is the boards in corporate America have changed dramatically in the last decades. And so it is no longer easy because the boards are pretty smart.
Right.
And they're very actively engaged. There's real kind of check and balance at most places. And so I think the combination of the two is it's not that easy to make money as an activist.
Nice note to end on. Anu, Ethan, thank you so much for the conversation, and thank you everyone for listening. Thank you.